Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all.
Imagine waking up one day and never having to stress about money again. Your bills are covered, and you're living the life you've always dreamed of. Sounds incredible, right? What if I told you this could be possible, thanks to the power of dividends? In 2020, companies in the S&P 500 paid their shareholders over $58 billion each month in dividends. Historically, dividends have contributed to around 42% of the stock market's total return. That's massive. Today, we're diving into how legendary investor Warren Buffett has mastered the art of using dividends to create a steady income stream, and how you can too. Let's start with the basics. What are dividends and why are they so crucial for financial independence? As Warren Buffett famously said, if you don't find a way to make money while you sleep, you will work until you die. Dividends are a way to do just that, making money passively while you focus on other things. Here's how it works. When you buy stock in a company, you become part owner of that business. If the company turns a profit, it can choose to share some of that money with you, the shareholder. This shared profit is called a dividend. Dividends are typically paid out regularly, most often every 3 months, but some companies distribute them monthly or annually. These payments can come in the form of cash or additional shares of stock. Simply put, dividends are your share of the company's success. For investors, this means a reliable income stream that can help you build wealth and achieve financial freedom. It's a strategy Warren Buffett has used masterfully to grow his fortune over the years.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock.
Warren Buffett believes that having a diverse mix of investments is essential, especially if you're still learning the ropes of investing. Think of it as a way to play it safe. Spreading your investments across different assets helps protect you from major losses if one area doesn't perform well. Diversification is like building a shield for your portfolio when you're unsure of your next move. But here's the kicker. If you're confident in your skills and truly understand what you're doing, Buffett says you might not need to diversify as much. Instead, you can focus on a smaller number of investments that you've thoroughly researched and believe in. In Buffett's own words, diversification is protection against ignorance. It makes little sense if you know what you are doing. So, whether you're just starting out or feel ready to zero in on specific opportunities, Buffett's advice is clear. Diversify wisely, and as your knowledge grows, so can your focus.
We had more reason to retain all of our earnings. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire. We like the companies in which we have investments to pay to us the money they can't use efficiently in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earn. We own some stocks that don't pay any dividends.
Building a dividend portfolio that stands the test of time requires a solid plan. Let's break it down into 3 key steps, inspired by Warren Buffett's approach. Step 1. Choose dividend-paying stocks. Start by selecting companies that consistently pay dividends, or better yet, those that have a history of growing their dividends over time. These are often stable, well-established businesses in sectors like household goods, utilities, or healthcare. But don't just pick any company, do your homework. Look into their financial health, competitive advantages, and whether they have the ability to keep paying dividends, even during tough economic times. The more you understand about a company, the stronger your portfolio will be. Step 2. Diversify your portfolio. Warren Buffett is a big believer in diversification. It's about spreading your investments across different industries to minimize risks. Why? Because no one can predict the market perfectly, and having all your money in one area could lead to big losses if that sector takes a hit. While dividend stocks provide a steady income, the market value of your investments can fluctuate. Diversifying your portfolio ensures you're better protected from unexpected downturns, keeping your investments safer in the long run. Step 3. Think long-term.
If you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life, you would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Warren Buffett is famous for his long-term approach to investing. He once said he likes to hold investments forever, and this mindset works perfectly when building a dividend portfolio. The magic happens when you reinvest the dividends you earn. Over time, this compounding effect can significantly boost your portfolio's value and future income. It's all about patience and letting your investments grow. Step 4. Assess potential risks. Another golden rule from Buffett is to avoid companies with high debt or those that frequently cut their dividends. These are often red flags that signal trouble. Instead, focus on businesses with strong financials and a proven track record of weathering tough economic times. A stable company today is more likely to provide reliable dividends tomorrow. Step 5. Monitor and adjust your portfolio. The economy evolves, and so do businesses. Buffett advises keeping a close eye on your investments and making adjustments when necessary to align with your financial goals. Regularly reviewing your portfolio ensures you're always on the right path to building wealth and maintaining a steady income stream. By following these steps, you can create an investment strategy that delivers consistent income while helping you achieve your financial dreams. Pro tip: stay ahead with Seeking Alpha. If you're wondering how I stay updated, let me introduce you to our channel's partner, Seeking Alpha. It's my go-to tool for smart investing. From uncovering hidden investment gems to reading earnings call transcripts and breaking news, Seeking Alpha has it all. Their Alpha Picks stock ratings are a game changer. Stocks marked as strong buy have outperformed the S&P 500 by 80%. That's huge. If you're serious about investing, give it a try. Strategy number 1. Blue chip dividend stocks.
Blue chip stamps when we owned it, or even diversified reading. We wanted them all to be compounding, in effect, be compounding machines. That's why people gave us capital. That's why we put our own capital. Recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically.
Buffett's Strategy number 2. Covered call ETFs. Another powerful way to boost your dividend income is through covered call ETFs. This strategy not only lets you earn money from dividends, but also generates extra income through options trading without requiring you to handle the complexities yourself. So how does it work? A covered call ETF is a fund that holds dividend-paying stocks and sells call options on those stocks. The income from selling those options is then distributed to investors as additional income. This increases the overall yield of the ETF, providing a steady cash flow that's especially appealing if you want regular income. Of course, there's a trade-off. While this strategy limits the maximum profit you can make if the stock price skyrockets, it compensates by offering consistent income, a perfect fit for those prioritizing cash flow over big market swings. As Warren Buffett says, risk comes from not knowing what you're doing. By understanding how covered call ETFs work and adding them to your portfolio, you can increase your income potential while managing risks. What's great about this strategy is that professional fund managers handle the options trading so you can benefit from it without diving into the complexities yourself. It's a win-win for boosting your dividend income and moving closer to financial independence. By combining blue-chip stocks, covered call ETFs, and dividend growth stocks, you're setting up a portfolio designed for stability, steady income, and long-term growth. If you enjoyed this breakdown, check out the next video where we dive even deeper into strategies for financial independence. Thanks for watching, and don't forget to like, subscribe, and share for more tips on growing your wealth.